Hello, welcome to JS Services Strategy Recap. Today we're going to go over a unique signature state called a neutral negative extreme. In this signature state, the market is pressing the lower support extreme of a neutral market state, and the expectation is for the market to either bounce back into neutral or transition into a negative bear trend state. Pressing the lower extreme, we're either going to bounce back, typically with a reversal, exhaustive turn, or it's going to start to transition lower. So big swings are the tell that the trade is going to turn digestive. If the market does produce a positive reaction off support, it will need to hold a rally through the midpoint or the directional to confirm a transition out of this extreme state. So we're pressing the lower extreme and we'll need to push through the directional if that's the case. Today we're going to look at the S&P 500. And that midpoint is 2053, and the lower extreme today is 2040.5. And the 2040.5 level represents our structure point, so this is our over-under number, our R level. So trading above this price we're positive, below we're negative, and that's defining that lower neutral negative extreme. You can see our indicator here, our MC value is plotted at -3. So it's at the low end of that neutral zone. Is it going to transition into a bear trend, or are we going to bounce back into neutral? We take a look at our strategies. So it's always an if-then statement. If we are in a neutral negative extreme market state and sentiment is equal to the downside pivot, or our DP, then the optimal strategy is to look for a buy DP reversal. So a reversal, we're looking for the market to exhaust below this price point. This is the optimal strategy as the market is pressing the lower extreme and we're anticipating it to bounce back. We're at a neutral extreme, we anticipate it to bounce back. Another optimal strategy is sell UP reversal, so if the market starts to rally higher and can't hold a breakout to the upside above the upside pivot or the top of this range, that would be another good strategy with the expectation the market's going to fall back into neutral. If the market breaks structure and transitions out of this neutral negative extreme state, one would be a breakout above the upside pivot where the market is pushed to the lower extreme, and then we get a breakout of this digestive range and a strong corrective rally out of that neutral area. Or we get a failure from the R level here at 2040.5 and we hold negative structure, and that signals a transition into a negative bear trend market state. So we're going to focus on this example here, a buy DP reversal or a buy R reversal. And since the R is equal to the DP, it's the same strategy, but the key is the reversal strategy. We've gone over reversal strategies before. I want to talk a little bit about the variances around the price map level. So we have a variance and an alert distance. And so for a reversal, the classic reversal is that you have 3 conditional alerts. A1, A2, A3. So A1, the market starts above the alert distance, goes through the figure, below the alert distance, and then comes back up through the alert distance, and that's the trigger. So a buy DP reversal is not true until you get these 3 conditions to happen. Once that happens, you can buy it right at the market, you can buy it a pullback back to the variance, buy it right at the alert distance, with the expectation that the market is going to follow through for at least one APMD, one average price map distance. So at least up to the directional, if not higher. That will depend on the market state, and we're in the neutral negative extreme, so we're anticipating a bounce back up to, let's say, the upside pivot. Another type of reversal conditional alert would use the variance as a trigger. So instead of having it be above the alert distance, it could be a trigger above the variance, below the variance, and above the variance, and then you could use a hard stop as it breaches the alert distance to add onto a trade. I added some ideas for some stop management. So below the alert distance, below the variance, below the figure, below the variance, you always want to use a couple, 2-3 ticks through that figure as kind of a rule of thumb. So that's the strategy. The big thing about a reversal, though, is it's an exhaustive event. And you could use an oscillator divergence signal, you could use a volume event. You're looking for that exhaustion. That's the key. Neutral negative extreme, the market's breaking hard, it's in an emotional state. We want it to exhaust through our figure and really have an emotional blow off and then have that V bounce and then it just takes off and it goes. That's what we're anticipating. That's what we want to see happen, and if it starts to play out, that's what we want to jump on. So again, we're looking at this opportunity here, a reversal off the 20, 40 and a half level DPR in the S&P 500. So here's the overnight action in the S&P. Here's our figure, R level. And so we can see overnight the market has already triggered our alert 1. So here's our alert distance. This line's our variance. So this is our condition 1. Then as we come into the regular session open, the market is opening up below the DPR. So as the market's in this situation here, it's pressed. What do we know for a fact? Well, fact is we know we're in a neutral negative extreme. And fact is we know we're below the DPR. We're going to look at, is this market holding negative price structure? Well, we had a break of that price structure here. The market started to build negative price structure, and then here we're getting a break in that structure. Still holding market structure here, so that's negative, and then we get this new breakout signal, and the market should just go. Is it going to transition? Is this negative emotion going to continue? It should just go. And then here it breaks this negative structure on the price wise, and then we get it to stabilize above the downside pivot, and then here we're getting a reversal signal confirmation on the alert distance. And then if we use the variance as our trigger, this is our variance, we had a confirmation here of a signal here. So then that provided a pullback to the figure, and then we had follow through. As you're here, you're anticipating a potential reversal. When they do this, this is a tell. They're breaking structure. They should have just gone. They didn't. And then when they do this, you have some clarity that this market might be reversing. Doesn't always go this fast, but this is a tell. This is actually a confirmation of this fired off a trigger to get long immediately here, and could add here. And let's say you missed this opportunity, and the market's trading here. What happens here is that the market broke below the market structure point, right? Broke through this variance, came back up through where that's a first break in market structure. Here we get a second break in market structure. So this is important. So at this point we have a lot of clarity that this was a reversal. And so that gives you a buy opportunity off this figure for an add-on. What's our minimum expectation? A play for the directional. So this is a half APMD move. And we can use this variance here for our stop placement. And this is a 1 to 3 risk reward ratio right here. But it's actually a bigger opportunity. Here it paid out a full APMD, and then it continues to follow through and breaks market structure here. So this is an additional tell that the market wants to go higher. If it was going to roll over from the directional, it should have stabilized below here and rolled over. But when it does this, it's positive. So when you're getting a squeeze here, it's building, it comes here, starts to break down this price structure, but even this is your second structure break. So when we're talking about structure breaks, anytime we're looking for a follow through, we're expecting an impulse move or a market to maintain positive price structure, higher move highs, higher move lows. So we have our first structure break, and then we have our second structure break that confirms that it's over. So this first structure break is just a tap on the brakes. Might put us into a digestive trade for half hour, 2 hours, maybe the rest of the session, and it's going to fall through in the later session. But if it's going to scale and really just go right away, it's not going to break that structure because it should just be textbook. So here we get that break in structure, price structure, the tap on the brakes, sets up this squeeze. We hold the second structure point. This is also an add-on situation because our trade vision is that we're at the neutral negative extreme. We're bouncing back into neutral, looking for an opportunity up to the upside pivot. Just clean it up. Here's the 1 APMD, 2 APMDs. So we have our reversal event, full APMD. They gave it another trigger here. You can use our metrics for our stop. It's always nice to see when price action is in confluence with market structure. So this is quantitative work, and you have your technical analysis here, just watching price action within market structure, and you have a 2 APMD move. This structure gives you your trade vision. The metrics can help you with your stop placement and your stop adjustment. The key is when the market's emotional here, you have clarity that you're in a neutral, negative, extreme market state. Understanding this foundation, neutral, negative, extreme market state, what are the attributes of it? Where are we at? We're in this situation. What's the structure? The structure, this is the defining point. If the market's going to go and transition negative, it's going to hold negative structure. When the market's in flux there and we're not sure, we're leaning on the optimal strategy theme. That's what's most likely to occur. And then they give us our trigger. So if we have our trigger, what's our trade vision? It can go to the upside pivot. How can we get on that train? How can we use the market structure to get on that train? We'll use price action within market structure. The quicker we can identify the turn, the quicker we can get on the train, the more opportunity we have. So as we continue to have more and more clarity. The market is transitioning up to the upside pivot. When can we get on? Even at these levels here, the market's telling it wants to go higher, it wants to press this level, and it holds these metrics here. And you can use those to define your risk management for shorter term opportunities. But know what you're getting involved with. Understanding that at this point it's the hardest time to get involved, and that's when you have to put on your biggest size, smaller size. This is a new big confirmation with a full AP and D expectation. This is decent size opportunity here. This is very small size. You're running out of room. Neutral, negative, extreme market states can be exciting. There's good volatility, especially when the sentiment bias is below the market, because it gives you some good definition for where you could get that positive reversal signal to bounce that market back into the neutral zone. For more information, please contact us at info@jsservices.com. Thank you.